The program examines the role of active management and tactical allocation decisions within alternative investments. Active management seeks to generate superior returns by identifying mispriced assets, exploiting market inefficiencies, and dynamically adjusting portfolio exposures. Unlike passive investing, active management relies heavily on manager skill, research capabilities, and market timing decisions. The program emphasizes that alternative investments often provide broader opportunities for active management because many alternative asset markets are less efficient, less transparent, and more specialized than traditional public markets. Successful active management requires disciplined investment processes, strong risk controls, and careful evaluation of market conditions. Investors must also recognize that higher potential returns are typically accompanied by increased complexity, operational risks, and manager selection challenges. Tactical asset allocation (TAA) refers to the active adjustment of portfolio exposures based on short to medium-term expectations regarding market conditions, valuations, or economic trends. Tactical allocation differs from strategic asset allocation because it focuses on temporary deviations from long-term target weights to exploit perceived opportunities. The program explains that TAA decisions may involve increasing or reducing exposures to specific asset classes, sectors, regions, or investment styles, depending on market outlooks. Tactical allocation strategies rely on forecasts related to interest rates, economic growth, inflation, volatility, and investor sentiment. While tactical allocation may enhance returns and reduce risk during certain market environments, it also introduces forecasting risk and implementation challenges that can negatively affect portfolio performance if market expectations prove incorrect. The fundamental law of active management provides a theoretical framework linking active investment performance to manager skill and breadth of investment opportunities. The law states that the information ratio, a measure of risk-adjusted active return, depends on both the manager's forecasting skill and the number of independent investment decisions made. In simplified terms, greater forecasting accuracy and a broader range of opportunities can improve active management performance. The program highlights that alternative investments often offer high breadth because managers may exploit inefficiencies across private markets, distressed assets, real estate, hedge funds, and structured products. However, successfully applying active management requires strong analytical capabilities, disciplined decision-making, and effective risk management, because poor forecasts or excessive concentration can significantly reduce portfolio performance. Costs related to alternative investments are an important consideration when evaluating active management strategies. Alternative investments generally involve higher fees and operational expenses than traditional investments because of their complexity, specialized expertise requirements, and active management structures. Common costs include management fees, performance fees, transaction expenses, due diligence costs, legal fees, and administrative expenses. Illiquidity also creates implicit costs because investors may be unable to access capital quickly during adverse market conditions. The program emphasizes that these costs can substantially reduce investor net returns and should therefore be evaluated carefully when assessing manager performance. Investors must determine whether active managers generate sufficient excess returns, or alpha, to justify the higher expenses associated with alternative investment strategies. The tactical allocation process involves several structured steps designed to identify and implement attractive investment opportunities. Managers begin by forming economic and market expectations based on macroeconomic analysis, valuation assessments, and risk considerations. They then evaluate portfolio exposures relative to strategic targets and identify tactical opportunities across asset classes or strategies. Risk management is integrated throughout the process to ensure that portfolio adjustments remain consistent with investment objectives and risk tolerance. The program notes that implementation may involve derivatives, leverage, hedging strategies, or direct asset allocation changes. Ongoing monitoring and reassessment are essential because market conditions evolve continuously. Successful tactical allocation therefore requires flexibility, disciplined execution, and the ability to respond effectively to changing economic and financial environments. Private equity funds represent one of the most significant areas where active management and tactical decision-making can influence investment outcomes. Private equity managers actively create value through operational improvements, strategic repositioning, financial restructuring, and governance enhancements within portfolio companies. These funds typically operate through limited partnership structures, where managers raise committed capital from institutional and high-net-worth investors. The program emphasizes that private equity investing requires long investment horizons, strong due diligence capabilities, and careful alignment of interests between managers and investors. Returns are influenced by manager skill, leverage, market timing, and economic conditions. While private equity funds may offer opportunities for substantial long-term returns, they also involve illiquidity, valuation uncertainty, and significant operational and execution risks that investors must manage carefully.